Good morning, everyone. Welcome to our Phillip Securities Research Weekly Morning Call. Today, we have a few updates, stock counter updates, including the initiation on PayPal, some technical analysis, as well as the macro sector outlook, including SGBanking monthly, US Bank third quarter results, US fourth quarter strategy and stock picks, some news from the Feds, as well as the usual Singapore weekly. With that, I'll hand over my time to Ambrish to start on PayPal.
Thank you, Max, and good morning, everyone. So last week we had released a PayPal initiation coverage report. So next slide, please. So PayPal, it is basically a fintech company, and it offers online payment services to individuals and businesses. It has a global presence across 200 countries and a large user base, which includes 392 million consumer accounts and about 34 million merchant accounts. So customers, they can use PayPal to transfer money online to other PayPal users, as well as to pay for any goods or services that they had purchased online or in store. So merchants, they can also create a business profile and they receive payments for whatever they sold. Last year in FY21, the PayPal, it reported a revenue of 25.4 billion US dollars. And about 92% of this total revenue was generated through transaction revenues. And this is mainly generated via charging fees to customers and merchants. And it is calculated as a percentage of the total payment volume which have been completed on its platform. And about 8% of the rest 8% of the revenue, it was generated through other value-added services. And its main component, it includes the interest which the company earned on the loans receivables. So also in last year, about 54% of revenue was generated in US, 9% in UK, and the remaining was generated through other countries. In terms of its net profit, the company, it reported a net profit of 4.2 billion US dollars and adjusted PATMI of about 5.5 billion US dollars. This excludes the non-cash expenses like stock-based compensation, as well as amortization of intangibles and strategic gains on investments. The company, it also reported strong free cash flows of about 5.4 billion US dollars, and this comes to a free cash flow margin of 21%. Next slide, please. So moving to our investment thesis, first one is PayPal. It's a two-sided network. It is a key competitive advantage. This is mainly because it serves both consumers and merchants, and it provides an end-to-end payment experience. So basically, for consumers, it provides a payment method through which they can transfer money or pay online. It also provides it also provides credit to the customers through its products like buy now and pay later. Whereas for merchants, it acts as a payment processor through which the merchants, they can accept payments from customers. It also provides loans to merchants based on their account history. And what PayPal does is it uses this transaction information and it comes to a consumer behavior, and then it offers a discounts to its customers in order to improve merchant sales. So its total payments volume, it also spiked from about 578 billion in FY18 to over 1 trillion last year. And this was mainly because of a larger user base as well as increased number of payments. We expect about 13 to 14% of revenue and payment volume growth this year. This is mainly because of strong network effect and secular tailwinds like digitization, online digital payments, and as well as a rise of online shopping. So moving on to the second thesis, PayPal boosts conversion rates and sales for merchants. This is mainly because consumers, they are likely to complete a purchase transaction if the core PayPal checkout option is available for them. This is mainly because of a better user experience and stored credentials, as well as a fewer clicks and redirects. The company claims that it has a conversion rate of about 80 to 90%. And as a result, the company it has partnered with about 75% of the top 1,500 retailers in North America and Europe. These includes Walmart, Shopify, and Booking.com. Also, we believe that new products and services such as QR code payments, it could help to improve the customer engagement and conversion rates for merchants. So moving on to our third thesis. Next slide. So Venmo monetization to support growth. Venmo, it was initially started as a free of charge peer-to-peer money transfer application, and it has about 80 to 90 million of user base. So company, it is now introducing several features by which it can monetize it. So it can be a merchant, they can create a business profile to accept payments, as well as it could be also used to purchase and sell cryptocurrencies. Additionally, Venmo would be added as a payment service on Amazon later this year. As a result, we would expect its payment volume on Venmo to surge from about 230 billion in FY21 to about 300 billion in FY22. And this is mainly due to the surge in digital payments on online shopping. So moving on to the risks, any deterioration in macroeconomic environment like inflation, it could lower consumer spending, and additionally, it could then impact PayPal's top line and profitability. And also, if there is a recession, then it has loans to consumers. So, I mean, it can also give additional defaults. Secondly, consumers' financial and personal data is stored on PayPal's platform. So it could be a target for hackers who want to commit fraud. And if any system failures, it could delay transfer of funds, and which could lead to consumers using it less. Lastly, PayPal also faces significant competition, mainly from the bank transfers as well as Western Union. And for Venmo, it faces a competition from Google Pay and Amazon Pay. So the company, it needs to innovate its platform to gain a competitive advantage. Next slide, please. In terms of its valuation, we have a target price of $116 US, and this is based on a DCF valuation with a 7% WACC and 4% terminal growth rate. So I would now like to pass on to Glenn for Singapore Banking Monthly.
Thanks, Ambrish. So moving on to the Banking Monthly. For the interest rates continued to increase in September. The 3-month SORA was up 42 basis points to 2.31%, while the 3-month SIBOR was up 32 basis points to 2.85%. And this is the highest that the interest rates have been in more than a decade. For the third quarter 22 3-month SORA, it is up 30 basis points quarter on quarter to 2.31%, and is spiked by a massive 218 basis points year on year. So this will only mean good news for the local banks as they look to end the year with a higher net interest margins and net interest income. Now, for the next slide. The loans growth has remained resilient in Singapore, and the overall loans to Singapore residents has risen by 6.7% in August to 843 billion, and is tracking our estimate of a mid-single-digit growth for 2022 as the economies in ASEAN begin to recover from the pandemic lockdowns and borders start to reopen. Business loans grew by 8.2% and the loans to the building and construction segment, which is the single largest business segment, grew 5.1% to 172.8 billion. While the loans to the manufacturing segment, it grew by 12.5% to 27.5 billion. For the consumer loans, it was up 4.3% to 315.8 billion, and this was aided by strong loan demand in the housing segment. Housing loans, which make up about 70% of the consumer lending, grew 5.3% to 221 billion. The total deposits and balances, which captures deposits in all currencies to non-bank customers, it grew by 11.8% to 1,723 billion. For the current account and savings account proportion, or CASA, it remains stable at 22.2% of total deposits, or 383 billion. For Hong Kong's domestic loans, the loans growth declined by 0.97% in August, and the year-on-year decline in loans growth for August was higher than the decline of 0.08% in July. Now, moving on to the next slide. Next slide, we see the SGX monthly statistics. So the preliminary SDAV for September, it did 7% year-on-year to 1,149 million, as the market sentiments remained subdued due to the macroeconomic factors. Whereas the VIX averaged 27.3 in September, and this was up from 22.2 in the previous month. And the DDAV rose 2% to 1.05 million, up from 0.9 million in August. The top 5 equity index futures turnover, however, saw a dip of 3.9% in September to 14.87 million contracts. And this was mainly due to the lower trading volumes of its FTSE China A50 index futures and the Nikkei 225 index futures. The third quarter 22 DDAV is up 2.4% on a year-on-year basis. Now for the next slide. As such, we maintain overweight and remain positive on the banks. The bank dividend yields are attractive with upside surprises due to excess capital ratios, and the stable economic conditions in ASEAN and rising interest rates remain tailwinds for the banking sector. The SGX is also another beneficiary of the higher interest rates. Now, for the next slide, please. Now, we've also we'll be going through a few of the US banks' third quarter 22 results. Just to reiterate that this is we don't cover the US banks and it's non-rated. So 4 of the US banks have released their results, and they are namely JP Morgan, Citigroup, Wells Fargo, as well as Morgan Stanley. So the story is quite similar to the second quarter, whereby they were mainly hurt by the higher provisioning as well as lower non-interest income. So if you look at the first red box, you can see that the net interest income has improved across the board for all the 4 banks. And this is the same story as it was the last quarter as well, mainly due to the higher interest rates. However, their non-interest income has all fell year on year, and this was mainly hurt by their investment banking segment. The provisions have also returned to a normalized basis, and you can see that they have increased their provisions across the board. So in the end, what does this mean for the banks? For the US banks is that their PATMI has all taken a hit on a year-on-year basis, and they've all recorded almost double-digit dips in their PATMI. So I think that's all I have for the banking sector. I'll now hand it over to Darren.
Thanks, Glenn. So we attended SPH REIT's full year 22 results. Yeah, so just a little bit on SPH REIT. SPH REIT is a retail REIT with 2.4 billion in assets in Singapore and Australia. So if you look at the graph on the top right, you can see their assets. Their biggest asset is Paragon. So 3 of them are in Singapore and 2 of them are in Australia. And for the full year 22, MPI rose 3.5% year-on-year to 209 million. And for 12 months, full year 22 DPU is up 2% year-on-year to 5.52 cents. The fourth quarter DPU was 1.39 cents, which is slightly down from previous year-on-year. The portfolio occupancy remains stable at 97.5% with a WALE of 5.3 years by NLA, and they have a high tenant retention rate of 82.9%. So the tenant sales for Singapore is up 8.8% year-on-year for 12 months for full year 22, and for footfall is up 15.9%, while in Australia it is tenant sales is up 4.2% and the footfall is down 3.6% respectively. So if you take a look at the chart on the bottom right, I mean, it's a little bit small, but we can see actually the tenant sales for Paragon, which is our biggest asset, is around pre-COVID levels, and the footfall is slightly under the pre-COVID levels by about 50 million. So the management comments for some of the retail trends, like for Paragon, the Indonesians are actually the major contributors and not the Chinese. So when China reopen their borders, then there will be more Chinese tourists, and that will be a leg up for Paragon. So for the breakdown, watch retailers actually they came in at double-digit growth, and food is doing well. Departmental stores are flat, and fashion remains challenged. That's for Paragon. But for Clementi Mall, the fashion is double-digit growth, while food is also doing well. So for the capital management front, their gearing is at 30%. The cost of debt is at 1.77% with a 7% fixed rate, and they have a weighted average term to maturity of 2.5 years. Utilities cost is about 3.3 to 4% of their total operating expenses. And right now, the electricity suppliers are not giving fixed contracts because of the macroeconomic uncertainty. So for the outlook, the rental reversions trend is expected to improve going forward, as seen from the footfall and tenant sales. So last year, SPH REIT had -8% negative reversions, and this year for the full year 22 is a -2%. So going forward, you expect it to lessen, to have a lower negative rather, so slightly improve. And they have a better conversion of footfall into sales for Clementi Mall, and the leasing momentum for Singapore has improved compared to Australia. So right now, SPH REIT is paying 6.5% dividend yield. So that's all for me. I'll hand over to Terence to talk about Keppel Corp.
Thanks, Darren, and good morning, everyone. Keppel Corporation entered into a amended agreement with Ball Drilling that will see the company de-risk inventory and also receive cash faster and also lower its overall gearing. So in terms of the news, Keppel has entered into an amended and restated framework deed with Ball Drilling. This is the third agreement that they have entered with Ball Drilling already. But under this new framework deed, the third framework deed, KOM or Keppel O&M will accelerate the delivery of 3 yet to be delivered jackup rigs to Ball between this month and July 2023. The 5 rigs that Keppel has entered into form part of the identified assets that were originally slated to be transferred to REITco as part of the agreements in connection with the proposed combination of KOM and Sembcorp Marine. The deliveries of the two other rigs will be deferred to 2025, in which Ball will pay holding costs and cost cover in respect of the deferred deliveries. So there's no cost at all for Keppel, because Ball will undertake all the costs required for the deferment of the remaining 2 rigs that is left. So in terms of the positives, the resolution for the 5 rigs will de-risk KOM's inventory because it will reduce the amount of stranded rigs on KOM's inventory and also deleverage KOM. The new resolution, the reason why is because the new resolution will enable KOM to receive full payments for the 3 rigs faster and also improve its cash flows. So they'll receive over $100 million in cash flows from this new agreement. It also reduce the counterparty risk and also provide a resolution to the stranded rigs that is stuck in their books. There will also be no impairment recorded for the third deferral of the 2 of the 5 undelivered jackup rigs that will be recorded. Separately, KOM also secured repeat new build FPSO contract P83 worth $2.8 billion from Petrobras. This brings its net order book to $11.8 billion. We say here repeat because they actually have other contracts that they already originally got from Petrobras. These are the P78 and P79. So the build of this is the same, but it's just that the P83 is bigger. So because it's bigger, the size of the contract is also bigger. Bigger in terms of, when we say bigger, it means the production capacity. For the P78, the production capacity is about 175,000 barrels of oil per day that it can generate. For this P83, they can generate 225,000 barrels of oil per day. So it's significantly more. It can store more of the oil. So that's why it's the contract value is higher. But in terms of the engineering and the design is the same. So for them, it's like building additional structure that they already are building, but then they get more. So and so that in total has boosted their order book to $11.8 billion now. And in our view, will enhance the proposition of the KOM SFM merger for for both sets of shareholders, because for Sam Marine, if they vote for the Sam Marine shareholders, if they vote for the deal, then this entire order book, if you look at the order book on your left hand side, this figure 1 here at $11.8 billion, which is even higher than the previous high of 2015's $5.1 billion, then this whole entire $11.8 billion will be subsumed under this new entity, Bayberry, and for the Sam Marine shareholders. So in terms of outlook, in our next slide, the preparations to complete the proposed O&M transactions are progressing well. We spoke to management. They are hopeful on meeting the timeline for completion. So we call it they hope to have everything settled by Q4, which is this quarter. So we continue to the relevant approvals are also on track. So they are optimistic on the due completion by the end of this quarter. Sorry. Yeah, KOM is also showing encouraging progress with its legacy REITs. As we can see from these latest amended terms that they signed with Ball Drilling, and it's also confident that these REITs can be substantially monetized over the next 3 to 5 years. So we maintain our buy call on Keppel with an unchanged sum of the parts target price of $8.95. This is still at a 20% HoldCo discount. We believe that we will likely reduce this HoldCo discount if they continue to transform their business to being asset light. So that's all from me for Keppel. I'll hand over the time to Zain.
Thanks, Terence. Good morning, everyone. I'll now go on to the technical analysis section. So for the STI, last week it looked like important change in trend. So for STI last week, we broke down 2 key trend line supports. The first one being the important one, stretching from the COVID lows back in March 2020. It has been supporting well until last week. And then we also broke down a key neckline support for the potential bearish head and shoulders that's forming on the index. So with that, likely there's more downside coming for the index. The immediate support will probably be at 2,880 to 3,020 zone. The first level of support, immediate one for this will probably be at 2,985. That's the 38.2% retracement level. As for the immediate resistance wise, it's likely to be at the 3,070 to 3,170 zone, which was the previous swing low for the index. Yeah. Next slide, please. For the S&P 500, it is also continue to remain in a downtrend. Specifically, it's currently stuck in this downtrend channel over here. As for the immediate resistance wise, likely to remain at 3,630 to 3,730, which was the previous swing low level back in June this year. That has become a resistance after we tested it in the start of the month this year, but continue to face rejection over there. As for the immediate support wise, I think it will be probably at 3,400 to 3,500 level. Which is the 161.8% Fibonacci extension from the first wave 1 to wave 2 of the downtrend from August this year. And 3,500 is also the 50% Fibonacci retracement level when we look at the March 2020 lows to the all-time highs. Next slide. For individual stock wise, we have 2 of them. The first one being Moderna. So for Moderna is a technical buy at $123.42. The first target price will be $144.50. The second target price is $156. Stop loss can be placed at $115.40, and the stop loss closed at $134 on Friday. For Moderna, we see a potential bullish reversal to the upside due to the formation of a bullish engulfing candlestick back on 10 October. After the stock broke out of a bullish falling wedge at the confluence of a double bottom support. And the MACD technical indicator also had a bullish divergence signal where it made a higher low when price made a lower low in the falling wedge, which gives a bullish upside signal. With that, the price could reach the first resistance zone at the 38.2% Fibo retracement level at $146.50, and the recent swing high resistance near $145 before it heads to the next resistance zone at the 50% Fibonacci retracement level. That's at $156.20, and the previous swing low support, which is also the previous swing low support, which it broke down in July this year, that's now acting as resistance. These Fibonacci levels are calculated using the swing high of $197.44 and the swing low of $115.03 as the points of reference. Next slide. So for the other stock will be Tesla. For Tesla, it was a technical buy at $217.24. The take profit at $260. The stop loss at $206. The stop loss closed at $204.99. So this trade was invalidated because it hit our stop loss. Last week we saw there was a potential bounce to retest the previous support turn resistance zone as the stock formed a spinning top candle on 12 October at the confluence of a trendline support and a horizontal support zone. That could suggest the recent bearish momentum is fading and the trend could be due for a short-term reversal. And bullish divergence was also observed in the MACD technical indicator. With that, the price could reach the resistance level near 260 to fill a price gap where it meets the 50% retracement level using the swing high of $313.80 and a swing low of $211.51 as the points of reference. And Elliott Wave also suggests that the stock could make a wave 4 pullback back into the resistance zone in the current downtrend, where 260 is a 61.8% Fibonacci retracement level when we use the wave 2 highs and the wave 3 lows. Given that the wave 3 has hit a 161.8% extension last week. So that's all from me for the technical analysis section. I'll now pass on my time to Jonathan.
Yeah, thanks, Sim. So we had our fourth quarter US strategy and stock picks on Thursday. So we'll just be running through some of the counters that we did. So for the first counter from Meta Platforms, we still believe that the company continues to be underappreciated. There are definitely some near-term uncertainty, particularly due to the general slowdown in digital advertising, which significantly affects Meta since that's most of its revenue. That's where it generates most of its revenue. At the same time, we do also see margins contracting, and one of the main reasons for this is obviously elevated expenditure surrounding the metaverse, as well as certain platform changes that the company had mentioned in their first and second quarter earnings. And that relates to transitioning to a more video-centric platform. But for why we really like the company is that it still has a very strong network effect. So it's got about 3.65 billion monthly active users. So if you take your global population minus China, since they're not really in China, that's more than 50% of your global population, which also is one of the reasons why user growth has stagnated quite a little bit, because it's increasingly incrementally more difficult to gain users once you have that many users already on your platform. The strong network effect is a positive for advertising revenue, because how advertisers or how you generate digital advertising dollars is through impressions. So basically, the more impressions you have and the better your targeted campaigns are, the more advertisers are willing to pay. The second positive that we're looking at is that Meta currently trades at relatively low valuations. So right now they're trading about 11 times forward P compared to its 10-year average of like 31, 32 times. It's about 1.5 standard deviations away from that. And it's also about half what the Nasdaq's average of 21 times 4 PE is. So we do think that there's been quite a lot of negative news surrounding Meta, and a lot of investors have been pretty much selling the company just based off news. And we think that this is could be a very sorry, it could be a very positive kind of a news for Meta, since that everyone is just selling it right now. Given that revenue generation is still fairly strong. Moving on to our next company, which is Netflix. So the title is that strong pricing power, and that's something that Netflix has been showing throughout the years. So this chart basically shows the monthly average revenue per membership, which is basically your price per membership, price per month. And you can see that the general trend is that it's been increasing quarter over quarter, or rather year over year, it's been increasing, even though it's been expanding into regions that may not monetize as well, particularly in the Asia Pacific region, and South America, where the prices are a lot lower than developed regions like North America and Europe. But so right now the prices on average are almost $12 per member. The company also has about slightly over 220 million subscribers. So if you compare this to its closest competitor, Disney, who has about 150 million, that's still about 50% more than Disney. Netflix also remains the market leader in streaming with about 47% market share. And its ARM of $12 is at least twice that of Disney Plus. So and also within the US, it has 3 times more viewing hours than Disney Plus. So even though Disney Plus has quite a lot of subscribers, it monetizes way less efficiently compared to Netflix, and it's also viewed a lot less than Netflix. The last positive that we see is that they're actually starting a new ad-supported subscription tier. So and it's going to be at a cheaper price. So I believe it's going to be around the $7 to $8 range. The main reasons for this is that they're targeting users that don't mind paying less for their services, with the inconvenience of having ads on their platforms. This will definitely benefit overall margins, especially because ad revenue is generally higher margin revenue, and it's a lot more scalable in the future, especially as the company scales up. One of the negatives the main negative that we see, like I mentioned earlier, is that user growth continues to stagnate in some developed countries. At the same time, password sharing has been quite an issue for the company, with significant revenue loss coming from people sharing passwords outside of their own household. For our next company, Alphabet. Alphabet remains the dominant player in digital advertising with more than 50% market share. And we do think that growth should remain resilient throughout the slowdown. I mean, obviously the big drawback on Google or Alphabet is that they have been slightly affected by the slowdown in digital advertising, especially as marketers are being a little bit more prudent in their spending, with a lot of people expecting a recession coming. The good thing about Alphabet is that in the second quarter of this year, revenue grew about 13% year on year, despite a 3% foreign exchange headwind. So if you include that, if you include a constant currency growth, it's about 16%. At the same time, Google Cloud, which is the company's fastest growing segment, grew at a 36% year on year growth rate, and is expected to grow in the 35 to 40% year on year growth rate for the next few years. Predominantly because it has such a large order backlog, which is boosted because a lot of people are starting to move into the cloud, and obviously which is your biggest digitalization trend globally. Alphabet is also has monopoly power in many of its other verticals like mobile OS, so Android mobile OS, as well as digital maps. So people really only use Google Maps nowadays. in terms of valuations, it's trading at a very attractive forward PE of about 17 times. Compare this to their average of about 22 times. It's slightly more than one standard deviation away from that. And the interesting thing is that we do expect EPS growth to be about hovering around the 20% range for the next couple of years. So with that, I'll pass my time back to Max to complete the rest of the thing. Thank you.
Thanks, John. So I'll start off with Apple. Firstly, for Apple, its highest margin services segment continues its year-on-year growth. And this is definitely beneficial for Apple because the services business segment is much more profitable with a gross margin of around 70% compared to its hardware product, which has only a gross margin of around 30%. And as we can see from the charts, the numbers are derived by taking the trailing 12 months of total services revenue earned divided by the total number of units of iPhone shipped during the same period. And this gives us an estimated amount of the services revenue earned per unit of iPhone sold. However, we would like to point out that this doesn't mean that a consumer will spend additional $200 to $300 on services after they bought an iPhone. It's just the numbers are meant to act as a proxy to show that the services segment is continuing its growth. Secondly is that we're also expecting a higher average selling price for iPhones moving forward. And this is mainly because Apple decided to discontinue its iPhone mini model, which has a lower selling price. And there are also reports circulating around indicating that the iPhone 14 Pro and 14 Pro Max are selling much better than the normal iPhone 14 models. So we feel that these two factors will help in jacking up the average selling price and will ultimately contribute to the revenue growth moving forward. However, as we all know, Apple has cut back on its plan to expand its iPhone production capacity. And we feel that this is not surprising given the current weak consumer discretionary spending because of the macroeconomic environment. So we feel that this will affect its sales in the near to medium term, and before it starts to rebound, before it starts to improve when inflation starts to taper down. Moving on to the next company is Amazon. Amazon is still a beneficiary of the continued migration to the cloud done by companies, as its AWS segment is still recording year-on-year and quarter-on-quarter growth. And this is also beneficial for Amazon because AWS is much more profitable as well, with an operating margin of around 30% compared to its retail business, which only has a gross operating margin of around 2 to 3%. So we are also expecting a strong second half of the year for Amazon, mainly because of the two Prime Day events that took place during this time. We see that these two primary events as a way for Amazon to firstly boost its revenue, and secondly is to clear some of its inventory that is currently at a high level. So, which brings us to the third point. The company's retail business segment is actually experiencing a shrinking margins with the high levels of inventory. The shrinking margins is mainly attributed to the inefficiency caused by the rapid expansion that the company did during the COVID times. And the high levels of inventory is actually in line with the rest of the retail industry. And this is mainly because of consumers shifting purchasing preferences, as well as them being more prudent because of recessionary fears. Yeah, so with that, I'll hand over my time to Ambrish to talk about Microsoft.
Thank you, Max. So for Microsoft, two main growth drivers are its Cloud Azure and Office 365 productivity software. So cloud, it basically means that you can store and access those data over the internet from anywhere, and there is no need to store that particular data on your local hard disk. So Cloud Azure, it is the second largest global cloud provider, and its market share increased from about 10% to 20% right now. And Amazon's web service, AWS, it is the largest public cloud. It has a market share of about 33%. We believe that Microsoft, it should continue to gain market share, mainly because company claims that it has a pricing power over AWS, as well as its Azure's integration capability with Office 365. And as the companies, they continue to digitize their operations in order to remain competitive. So the growth in Azure, it would also benefit Microsoft mainly because it is a high margin business. Secondly, Microsoft, it has a 90% market share in overall productivity software market. And the key growth drivers would be the need to manage tasks and workflows efficiently and the economic reopening. So as the companies, Microsoft mainly focused on corporate spending. So as they hire employees, the demand for its productivity software would be high. In terms of its negatives, the company is witnessing a slowdown in its Windows revenue, and mainly because of the slowdown in PC sales, which was at high because during the pandemic, mainly because of educational and student, they preferred to work from home. And the slowdown is mainly because of weak demand and supply chain issues, as well as global chip shortage. So overall, we have a buy recommendation for Microsoft with a target price of $332. I would now like to pass on to Max for Property Guru.
Thanks, Ambrish. So recently, we also initiated coverage on two new companies, particularly Property Guru and Spotify. So I'll go through Property Guru. For information, Property Guru is a company operating an online digital property marketplace, and we have identified several investment merits for Property Guru. The first one being it has a dominant presence with 76, 96, and 71% market share in Singapore, Malaysia, and Vietnam, respectively. So its revenue also experienced a 4-year compounded annual growth rate of 22% from 45 million in FY17 to 101 million in FY21. And we expect this to grow even further at a 2-year CAGR of 37% to reach 189 million by FY23. Furthermore, its dominance can also act as a barrier to entry for new entrants attempting to compete for market share. And this is because of the strong network effect resulting from the high penetration onto its platform. This is because as more users go to Property Guru when they look for homes, the more incentivized agents are to subscribe to its services. And on the flip side, as more agents post their listings onto the platform, the more users will go to Property Guru because it offers them more options all in one place. So this continuous cycle will keep on going and ultimately result in increased number of platform users. Secondly, Property Guru also possesses strong pricing power with a high renewal rate. The company offers several pricing tiers for its agent customers depending on the benefits that the customers need. So it's Property Guru's most basic product has a price of around 42% more than that of its more expensive than that of its biggest competitor, but it still managed to achieve around 82% of renewal in the first half of 2022. We believe that this signals that Property Guru is able to grow its revenue by incrementally increasing its product prices moving forward. And this is especially true when agents are likely to face high cost of switching to another platform when home buyers are already accustomed to using Property Guru. However, the company has limited penetration in Thailand and Indonesia. It has operated in both countries since 2011, but both markets only combine for around 8% of the total revenue in FY21. So we feel that especially for Indonesia, representing around 40% of the total population in Southeast Asia and the biggest market opportunity, we feel that this means that Property Guru has limited capability to capture and grow its market share there. And now I would like to pass on my time back to John.
Thanks, Max. So for Spotify, we initiated coverage with a buy. And Spotify, you know, is the leading global audio platform for I guess streaming music. They have about 31% market share and has more users than the next two competitors combined. One of the main reasons why we really like it is that they're growing both their users and their prices, so similar to Netflix. Revenue has grown more than 3 times over the last 5 years, and they also added over 300 million users. And one of the reasons why they've been able to do that is that they've actually been investing heavily in expanding their content library. One of the second positives for Spotify is that it's got a very resilient recurring revenue business model, which we like. At the same time, churn levels remain low and are improving year on year. In terms of its recurring revenue, that's mainly coming from its premium revenue, which are premium subscribers. There are currently about 190 million premium subscribers, so that's about 40% of total user base. With premium revenue growing at about a 26% 5-year compound annual growth rate. The one knock that we have on Spotify is that it relies quite heavily on third-party licensing agreements with its record labels and distributors. So essentially, every time it gets into these agreements, that every time a song is played, like 1 or 2 cents goes to these parties. Just for some context, Spotify spent about 7 billion euros in FY21. Or rather, they paid out 7 billion euros to these third-party record labels and publishers, which makes up about 75% of its total revenue. But all in all, we still think that the company is actually starting to expand its margins, especially as it focuses on generating more ad revenue in its podcast and audiobook segments. And it's also a beneficiary of tailwinds in the audio industry that's seeing an increase in adoption globally, particularly in APAC, where user growth is growing at a 40% year-on-year rate. So with that, I think that comes to the end of Spotify. I'll pass my time back to, I believe, Sean. Thank you.
Yep. Thanks, John. So I'll be going through a rough highlights on the Fed's minutes that was released last Wednesday. In the minutes, the committee have mentioned that the labor demand remains strong and the labor market continues to be very tight. Personal consumption expenditure, PCE, an indicator used by the Fed to measure inflation rate, still remains elevated, and the headline PCE increased 0.3% in August as compared to the decline of 0.1% in July. And on a year-on-year basis, core PCE, which excludes changes in consumer energy prices and many consumer food prices, increased 4.9%, more than 4.7% estimated and up from 4.7% the previous month. Despite unemployment edging up from 3.6% in June to 3.7% in August, the increase in unemployment rate is still not rising. The increase in unemployment rate is still not rising as what the committee have initially expected. With the rising rates, credit still remains widely available to most types of borrowers, but increase in borrowing costs appeared to have dampened the demand for credit in some markets. Recently, expectation of future credit quality for business have deteriorated slightly, and delinquency rate rose for some types of credit-owned household with lower credit scores. The difficulty in obtaining credits have also turned up a notch as compared to a year earlier, and is expected to be under closer scrutiny over the next year. Moving on to outlook, the projection from the Fed still remains relatively weak, with Russia's war in Ukraine, weakening activities abroad, and ongoing supply chains bottlenecks could require a greater than assumed amount of tightening in financial condition, as it was viewed by the committee as a salient downside risk to their forecast. In addition, the committee have also mentioned that the possibility that a wage increase may also put a greater than expected amount of upward pressure on price inflation if left unchecked. Some of the key comments made by federal officials last week, sorry for the typo here, like Loretta Mester, who mentioned despite some moderations on the demand side of the economy and nascent signs of improvement in supply side conditions, there has been no progress on inflation. And also James Bullard, who has also mentioned that there is not much indication that we are getting the disinflation that we are looking for, points towards that the federal officials and the Fed still remains firm in their hawkish stance of bringing inflation down to the targeted range of 2%, with tighter monetary policy, and emphasizing that historical experience have demonstrated the danger of prematurely ending period of tight monetary policy. Unless there is significant data points to point towards that the Fed have raised the rates to a sufficient restrictive level, in the meantime, we can buckle up as we can be certain that there will be more interest rate coming up our way in the near term. With that, I think we can hand over the time to Paul to discuss about Singapore Weekly.
Thanks, Sean. Yeah, so Paul actually had to run to a lunch meeting, so I'll try to run through some of these slides with the help of Terence. Next slide, please. I guess I'll cover the US side first. In terms of what happened last week, core CPI rose to 6.6% year on year, which was a 0.3% increase month over month, and was actually a 40-year high since August of 1982. Some of the main drivers for this, we think that I guess would be wages, as wages have been increasing. When it comes to retail sales, excluding vehicles, retail sales came in at 8.9% year on year, down slightly from August, where it was 10%. So we are seeing retail sales remaining quite robust, especially compared to I guess pre-pandemic. It is still higher than pre-pandemic, but we do see this slowing down, especially coming to the end of the year, which may not be the best for a lot of retailers. For the Singapore part, I think I'll just skip that. But onto the what's happening this week. On the 16th of October, there was the 20th Party Congress. On the 18th of October, actually we do have quite a lot of earnings for this week, especially for US earnings. So we have Netflix on the 18th, which is tomorrow night. We've got Bank of America tonight, and Tesla on Wednesday night. For the webinars for this week, we have SETS, and that's only for TRs. We have RENS and then Keppel REIT on the 3rd of November. Next slide, please. We'll skip this. Next slide, please. Terence, you think you could help out with this slide?
Yeah, so the MAS has actually recentered their near to around 5%. Last week they actually decided to appreciate the Sing dollar a little bit more aggressively in view of inflation. So whenever you see this recentering, it means that their view of inflation is a little bit more negative lah. And then for this time around, the recentering is also on the higher end of their guidance previously. So it just tells you that their view of inflation, the imported inflation, is quite negative. Yeah. I think we can go to the next slide.
Okay, I can take these.
Yeah,
Terence. So I guess most of you guys would have known that inflation actually accelerated a little bit, which is, I guess, a very negative thing for markets, because the expectation is that the Fed's going to come down even harder to make sure core inflation starts coming down a little bit. And the main metric that the Fed actually looks at is your core inflation, so your core CPI and your core PCE. And this strips out a lot of your more volatile sectors like energy and food. In terms of its components, you can see that the chart on the right, so you can see that goods inflation has started coming down, energy has started coming down, your oil prices have started coming down quite significantly. But what's really supporting the high or the high-ish CPI numbers is services that have been increasing. The main reason for this is we think the main reason for this is that wages have continued to increase. So they've been increasing at 5-6% year-on-year rate each month in many states in the US. So this could be couple of this with a relatively low unemployment. So most people have jobs, higher paying jobs. This could be one of the main contributing factors to rising services. Next slide, please. Yeah, so retail sales, like I mentioned just now, they're still above the pre-pandemic levels, but you can see this really big drop off from 2001 to from 2021 to 2022. You can see this big spike was due to people just, I guess, buying a lot of your durable goods, like buying a lot of furniture, a lot of electronics products. Especially in the US with all the stimulus checks that they were receiving, they're just spending money. But since then, there's been quite a big taper off. But still, above pre-pandemic levels of 4%. So still almost double that of pre-pandemic levels. In terms of inventories, August inventories were up about 21% year on year, versus retail sales of 10% year on year. So what this really means is that inventories are starting to outstrip sales. So you're starting to get a larger pile of inventories in your warehouses, especially in a lot of retailers like Walmart, Target, etc. And this is actually very interesting because what these retailers have actually said is that because of the high inventories, they're starting to offer a lot of their merchandisers at larger discounts, which is a negative for them because it shrinks a lot of their margins. But in this kind of aspect, which is sort of a deflationary act, when you can start buying a lot of merchandise cheaper on the shelves, it should by right help to at least slow inflation or maintain it at the current levels. At least better than when prices were soaring. Next slide, please. So this is just a chart of a Fed funds rate, which is in red. So right now, the Fed funds rate is about 3.08%, versus the 2-year treasuries, which is at 4.5%. So basically, what this chart says is that the market is pricing in interest rates to be around 4.5% in the next, I guess, 2 years from now, which is largely in line with market expectation of Fed funds rate hikes, where it will stay at about 4% plus level throughout the whole of 2023. Next slide, please. I think, I guess this is the last slide on Phillip on the ground. I don't think I'll run through it because I was not there. So I think we can move on to the Q&A for now.
Let me take some of the questions first. I'll take a few of the banking questions. So one of them asked if US bank PATMI has declined by double digits. Why are we still so positive on the Singapore banks? So even if their interest margins may increase, would their PATMI not also decline like those of the US banks? Okay, so I think if we look back at the US banks results, you can see that they were mainly hit by their investment banking and their provisions. So their provisions have reversed, and it's quite a drastic reversal. So previously from they were giving the provisions were negative. So now it's go back to the normalized basis. So Singapore banks, they have not reversed it that much. So what they have done is they have just lowered their provisions, but it's still quite stable. And also they don't really have such a big I would say investment banking. They're not so dependent on their investment. They don't really have investment banking like arm, as I would put it. So they would definitely be affected by slower loans growth. But it's still growing. So their net interest income will still expand. And this will definitely be outpacing their fee income decline. So the fee income decline, if you compare Singapore to US banks, it's not as badly hit. And also their provisions also not as badly hit. So in general, the Singapore banks will definitely still be we are still positive on the Singapore banks. And we would definitely expect that their PATMI will still increase. And it has been increasing for the past several quarters. For this year, yes, definitely their PATMI increase. For next year, they would continue as well. So there's another question about the US banks. So among the major US banks, which one would likely benefit the most with continual interest rates rise? He also said that I suppose all should, but which one benefits the most? It's a bit hard for me to say which one would benefit the most. I mean, we don't really cover US banks. But if you just look at the deposits, I would say of the 4 banks that I touched upon earlier, I think JP Morgan has the highest deposits. So, you know, with how you benefit from the interest rates will be from your deposits. So, you know, just by briefly looking at it, I would say the one with the most deposits would win, you know, would benefit the most. But I would think all the banks would benefit from this interest rates rise. But of course, there's other factors in play, not just the interest rates. I think there's one more question for me. US bank earnings are contracting versus last year. Is this the trend for Singapore banks too? Okay, I think I touched that earlier with the previous question as well. So that's all I have for my questions. I'll hand it over to the rest of my colleagues. Thanks.
Yeah, I think I take some of the questions also. Is there a deadline for the KOM Sembcorp Marine merger to take place? It has been very long. Yeah, so the deadline is for the 4th quarter, this 4th quarter of this year. So they previously guided for this and there's been no change. Yep. I'll take the next question. What's the fundamental outlook for sets with WFS acquisition? And every day you short this counter as well. Yeah, so for sets, they need to get shareholders approval by the 4th quarter of this year. They're looking to get, because the acquisition of Worldwide Flight Services is a material transaction, so they need to get shareholders approval first at the EGM. But what they're trying to do is they're trying to sort out the funding of this WFS acquisition as well. So they hope to get both of the approvals done by the hopefully late 1st quarter or early or 1st quarter of 2023. In terms of the outlook for sets after the Worldwide Flight Services acquisition, is the key for them. The deal will be accretive for them, even assuming that they go for full rights issue. But the outlook for them is whether they can actually gain synergies from the acquisition, which is something that is uncertain right now. And then but in terms of the outlook for the industry, we've seen a recovery in the sector, so we continue to expect that recovery. But the synergies will be the one that we'll be looking out for. Let me see if there's anything else. I think there's a follow-up question. If deadline for KOM Sam Marine is for 4th quarter, then the increased business for KOM will benefit the merger, not Keppel Corp, correct? Yes. So this, assuming that's a good question. Thanks, Ken Kwok. Assuming the shareholders for Sam Marine also approve the merger and the KOM is subsumed under the new entity Bayberry, then the new entity will benefit from all the new increased business, not Keppel Corp, because Keppel Corp really intend to divest the business. But obviously, so this is actually, all these additional businesses is actually a deal sweetener in our view to the merger. So yeah, let me know if you have another follow-up question. What is your take on the fast falling stock price of ST Engineering? What are the reasons? Yeah, so there are two main reasons for the sharp fall in ST Engineering stock price. Firstly, is they lost the deal recently. The supply of US Army equipment to BAE Systems, so they lost out to them. So the deal was actually not very big, but then the market took it more negatively. So there was a sell down. The second reason is because a majority of their debt, probably about 35% to 45% of their debt, is denominated in US commercial papers. And so what happened is that these commercial papers are generally short-term in nature. And with the surging interest rates that we're all familiar with by now in the US, what happens is that when SETs refinance these commercial papers, then their cost of debt will actually increase. It means they have to pay more interest for these commercial papers. So that's going to take a hit on their net profit. I think internally, when we look at this, there'll be about 6 to 7% impact, assuming looking at the trajectory of interest rates on their net profit. But otherwise, the 6 to 7% impact also don't justify why the sharp decrease in the share price. So, but these are the two main reasons now. Terence, any antitrust possible for SETs acquisition? Yeah, what happened is that when SETs went to acquire Worldwide Flight Services, they encountered global antitrust lawyers on the deal before they announced it, and the antitrust lawyers have looked at the deal, and they at this moment they don't believe there will be any obstacle to getting the antitrust approval. But that's a good question. Thanks. Another question on SETs, Terence, regarding SETs. After the Worldwide Flight Services acquisition was announced, share price dropped sharply. Then CEO came out to say we'll have limited rights issue. Following that, Temasek Holdings, I think that's what you mean by TH, started selling too. What do you think is going on? They did not do a good job in scenarios. Why Temasek is selling? Yeah, so I think there are a few questions here. Let me take the first part of the question. Yeah, so when the CEO, when the SET CEO came out to say that they wanted to do a limited rights issue, I think what he was trying to do is trying to clear the air, because when they announced the acquisition of Worldwide Flight Services, they didn't announce how they will fund it. They said that it will be an equity issuance. Just some backdrop. They said that it will be an equity issuance of $1.7 billion, and this will be a mixture of placement and a rights issue. They were probably not so clear, but their preference would be that this be funded by a bigger proportion of it be funded by a placement versus a rights issue. The reason why they want more of it to be done by placement is because the discount to the market price is typically lower. And so that means that the dilution will be less. But having said that, I think what is important is that in their Chapter 10 announcement, which is a compulsory announcement, what they did was to assume a worst case scenario where 100% of the equity fundraising that they're going to raise will be through rights. And in that exercise, it means, to be absolutely clear, that there will not be any placement. That is all going to be funded by rights, by existing shareholders. Then SETs will still see an accretion to their earnings per share. So even in that worst case scenario, so to speak, SETs will still see an accretion in their EPS from the acquisition. So that is, I think, what they want to make clear. But until the announcement is made on the funding structure, I think there will be that overhang, and until that overhang is removed, the share price will also likely be range bound until there's some clarity, because there's no clarity now, right, on the funding structure. So until there's some clarity on the funding structure, we believe the share price will continue to be range bound. I think that's the second part of the question. They did not do a good job in scenarios. Why is Temasek Holdings selling? So we cannot speculate on the reasons, and it's also not useful for us to speculate on why Temasek Holdings is selling. We understand it to be a normal market transaction. They do buy and sell based on their own outlook on the macroeconomic backdrop. But what we do know is that, based on the official statements that Temasek Holdings has made with regards to the deal, is they will support, as majority shareholder, they have about 39% of SETs as majority shareholder, they will and have provided unequivocal support to irrevocable support for the acquisition, which means that when they go for the EGM vote on whether they will acquire Worldwide Flight Services, they have provided irrevocable support that they will support the transaction. So if the speculation here is that Temasek Holding is not happy with the deal, they could have, they wouldn't have provided the irrevocable support for the transaction in the first place. So hope that clarifies. But if I didn't clarify, please feel free to clarify. ST Engineering, how big is the USD loss? Top of my head, I think it's about $600 million. Please feel free to email me. I'll probably provide the number later, but top of the head, probably about 600 million. Yeah, but having said that, Kian Kuo, I think what is more important to highlight is that even though they lost that deal, that to BAE Systems, their order book now is about $23 billion US, which is a 6 to 7 year high, compared to their average. Their average is about 16 billion Sing dollars in terms of their order book. So that now is about $23 billion. And most of the order book they expect to realize within the next 12 to 15 months. So we can see how that in terms of the impact to their bottom line is also not going to be very huge. Yeah, thanks for the question. I think that's all for me. I'll hand back to the rest of my team.
Okay. Darren, do you want to take first?
Okay. Yeah, let me just answer some REITs questions. So there's one question. It seems many REITs prices have collapsed, especially US REITs with yields reaching 12 to 13%. Do you see value in REITs? Any comments how REITs will recover, factors to watch? So for this, right, we do see value in some of the REITs, but then we understand that the sentiment for the REITs are very bad right now because of the rising interest rates, and we do not know when exactly the Fed will stop rising the interest rate, especially every time when the CPI prints out, it keeps keeps the print keeps coming over the expectations, always upside surprise. So we don't know when this will continue. So we think a pivot will be when we have certainty when Fed has actually maybe kept the rates, or maybe we see that the rates are coming down. If the US does enter into a recession, then definitely the Feds will be more cautious in rising the rates further, and then they will start to actually lower the rates. That is when we think there is a good catalyst for the REITs to recover. Yeah, another one is other than Prime US Escort REIT, what are other topics for REITs for bottom picking? So yeah, we like those two REITs because they, like for Escort, they can reprice the rental income fast with the RevPAR growth, and for Prime because of their resilient portfolio. But then for other REITs, like in general, like industrial and data center ones, for data center and industrial, because they have normally they have quite a long WALE. So because of the long WALE, then the weighted average lease expiry, then they'll take longer for to reprice the rents. So a lot of it, there will be stagnant rents with maybe a small rental escalation every year. So because of that, we see Escort and Prime as the better picks as compared to the industrial and data center groups. Cost also, like acquisitions, is quite tough to acquire now that interest rates are rising and cap rates are maintaining flat. So it's hard to get any accretive acquisitions for these REITs. Yeah, so for REITs, we are still quite underweight, but we do see some. We do think it may recover in first quarter or first half of next year. Yeah. So I think that's all of the REITs questions there. I'll hand over to Sean for now. Sean, you're muted.
Sorry.
So yeah, I'll take the question on, do you think a Fed pivot is coming in the first quarter of 2023? So regarding this question, the dot plot graph that was released in the September's meeting and the Fed funds future, which is what the market or speculators are expecting for the future rate hikes, is also suggesting that the rate would start to taper off around the first quarter of 2023. But however, these are still just an estimation, as we will have to wait for further indication and the subsequent Fed meetings to have more certainty for a potential pivot. Yep, hope that answers your question. With that, I'll hand over the time to my other colleagues.
Thanks, Sean. I'll answer a couple of questions for your side. The question here, what if inflation still could not be tamed despite Fed increasing interest rates? Is such a scenario possible? And what would it lead the global economy into if the Fed is out of other tools to combat inflation except rising interest rates? Yeah, so the issue with inflation, or rather the issue with Fed policies, is that they can only really affect the demand side. So right now we're still seeing quite a bit of supply chain issues that are obviously a big reason for inflation in many areas. I guess the short answer would be yes, it's possible, but it's a very unlikely scenario. If it does happen, then it's probably going to be pretty bad for everybody. But one of the things that I guess that is supporting the US economy right now is that we've got a really tight labor market. At the same time, the financial systems are in a lot better condition than better position than it was in 2008. So you can kind of see inflation already tapering. It may not be going straight down, but like it went straight up in the last few months. But we do see that there are some deflationary elements to it, and we do expect inflation to at least kind of slowly come down. It may take a couple of years for it to come back down to acceptable levels, but we do think that there are certain things like freight rates are coming down, and obviously along the whole supply chain, if your freight rates are coming down, generally goods will be cheaper to transport than to export and to import. But yeah, I mean, it definitely isn't out of the question for the Fed to continue raising rates to your high single digits or even into double digits like it did in the past. But we don't really see that happening, at least at the current rate of how inflation is tapering. We don't think that we don't think that the scenario is going to happen. Yeah. Hope that answers your question, BY. The second question is on US counters. You see that you have more and more US counters being covered. Is it where you see more opportunities and retail investors should pay more attention? Yeah, I think one of the reasons is obviously because the US is such a big market. It's like the FANG-Ms are already bigger than, in terms of market cap, bigger than the whole of Southeast Asia. But secondly, there are also a lot of companies that may not be so well known to investors. A lot of companies that maybe we use on a daily basis, but as for example, like Spotify, to a lesser degree, PayPal, Property Guru if you're looking for properties. Even though some of them may not be operating in the US, but for the most part, these are global companies that operate not just in Southeast Asia but outside. And for US companies, obviously they are global companies, like your Spotify, Google, etc. We do think that because it is a larger market, because the volumes are a lot bigger, because revenue generation is still very strong amongst a lot of the companies in the US, it is a good opportunity for us to cover and for us to share with our clients and for retail investors in general, particularly in this environment when everything has been sold off to the companies that are down 60-80% this year. We do see a lot of opportunities in the companies for in the medium to long term, which is generally our how we approach covering companies. We are less inclined to short-term swings, but we do like fundamentally strong companies. Yeah, hope that answers your question. I think that's all for the US side. I'll pass my time back to my colleagues to kind of wrap it up. Thank you.
Thanks, Sean. So I think I can start covering some of the TA questions. First one is Fraser's center point. So for this recently it broke down the key support level at about around 210 to 216, 217 area over here. And now currently it has turned to become a resistance zone. When you look at the Fibonacci retracement level from the COVID lows to the bounce back over here around close to 250 area, I think the next support level that we might head to is near maybe 194. That's the 50% Fibonacci retracement area. And we also have a swing low here around close to 190 over here back in October 2020. So we could see some further pullback in the price to this support level, and also we are currently stuck in this downtrend channel. So some support may be near here, this area, or at least maybe $2 and below. Mapletree Pan Asia also recently we broke down the last swing low over here around 167, 168, and also it was a convincing breakdown of the 170 key support zone over here. Looks like we hit the 61% level. That's about 159, 160. Today with the day low was 158. Then last time I think we had a swing low at 157. So maybe let's see whether some support comes in over here at this support zone. If we do get lower than that, I think that we could go to the next swing low. That's about 149, 150 area. As for prime US, I think we are currently near a support zone. So last time around the 45 cents to 49 cents area over here, we had this was a swing low. We have swing low back then around 46 cents. So currently we are at around this zone, the potential support area. But if we do break down lower than that, I think likely we go down back to the COVID low. That's around 40 cents to 40.5 cents. As for the current resistance wise, it's near, I think, 55 cents. It's a 61.8% Fibonacci retracement level. And over here, when during the recent sell down, we saw a small bounce over here back to around 55.5 cents. Then we got rejected and continue to sell down further. So moving on, for Yang Zhejiang looks like it's currently potential cup and handle formation. So last week we went up back to the resistance zone to about 120 to 127 over here. We reached a high of 125. It started to pull back. So now the current support zone is about 108 to 111 over this zone over here. And it also meets with this trendline support over here. And if this cup and handle plays out, right, then the support of the handle is also around maybe 109, 110 area over here, as well as is also the 61.8% Fibonacci retracement area. As for Chip Eng Sing, last week, after we broke out of this downtrend resistance line, we headed to this to test this resistance around 73 to 73.5 cents. Then we pull back again. So let's see whether this this resistance zone that we broke out of around 70 cents over here can continue to hold. If not, there's a chance that we might come back down to this next support zone, which is around 67 to 68 cents area. As for Golden Energy, last week after the news of potential deal, we saw it broke out of this rising wedge pattern. And then we went to a high of 94.5 cents. Then we formed another potential rising wedge over here that we broke down today. So for now, the current resistance is about 925 to 945 area over here. As for the immediate support wise, let's see whether the resistance of this rising wedge can hold it for now. That's about 875 to 880. If not, we might come back down to the previous resistance area where now turn support. That's about 810 to 850 area over here. And moving on to the local banks, DBS looks like the short-term uptrend has been ended today. So previously, it is holding very nicely in this uptrend channel over here. Then it had a resistance of around 3320 to 3380 area. Then today we opened below this channel's support line, and then we had upper way rejection over here, which signals that uptrend could be ended. So the next support zone could be at around close to 3180, or this swing over here, or around 3210, which is another swing over here. Next for UOB, after we broke down this support zone and the consolidating wedge at around 2670 to 2690, we are kept in this downtrend channel over here. Then last week we also found resistance at the downtrend channel, and that's about 2650. So if this swing go around $26 can't hold, right, it's likely that we move down to the test support over here of the channel, and also possible retest of this swing low of the July lows. That's about near 2540 area to 2540 to 2570 area. Then for OCBC, last week we managed to fill a price gap over here between about 1158 to 1166. So then we're also in this downtrend channel. So I think the next level we could hit is possibly 61.8. If we hit it today, that 61.8% level, that's 1150 over here. If we pull back further, we might come to the support of this channel over here, and then also previous resistance turn support zone over here. So that's about 1120 to 1130 area. Yeah, and we could also meet with this trend line support since November 2021 that's holding OCBC over here. Okay, then for AEM, it's brutal sell down last week. Then we came to this important previous support zone. There's about I think 305 to around 323 over here. So back then it was a previous resistance that managed to turn support over here, and then we fell straight back into this area over here. And it's also the 50% Fibonacci retracement level from the COVID lows to the highs for AEM. Let's see whether some support comes in for a potential bounce. Then the immediate resistance will be around 347 to 369 possibly. If not, if the sell-off continues, then we might go to the 61.8% level. That's near 275. And that's also where we had a swing back over in May 2020 to June 2020. We had two swing lows that occurred at this price level. Do note we also have a price gap that could be filled. That's about 247 to 264. Yeah. So that's for AEM. China Aviation, I think, okay, I'll present in a weekly frame. So from a weekly point of view, we came back to retest the March 2020 lows. That's about 66 cents. We are back here. Let's see whether some support can come in for a bounce. Then the immediate resistance wise probably lie around 73, about 73 cents, 74 cents area. If we continue to get the price continue to goes down, then maybe the next support zone might be around 52 cents to 59 cents zone, which was a swing low. Some swing lows generated, key swing lows generated over time in 2011, 2015, as well in 2016 as well. Then for SGX, okay, so not looking good. We broke down a recent a swing low in November 2011. 2021. That's around 870. Currently we are at 850. So I think the next, looking back, the next support area could be near around 810 area. So the support zone could be at around 780 to 820, but the last swing low back then was around 810 area, and also the previous resistance back in 2020. Okay, then for Singtel, I think one thing to note is that the longer term trend for the longer term uptrend from stretching back from November 2020 could be in danger. So there was this uptrend line that's holding Singtel all the way. Then recently there's a breach of it. So now it has become a resistance area around 250 to 255 over here. So I think the next support level is around maybe 240 level, which was a swing low in June this year. And if you go lower than that, we might come to the 50% retracement area. That's around 235, which is near another swing low over here as well. So that's for Singtel. Semicon industry looks like the uptrend has been ended for now, since we are making a series of lower highs and lower lows in this downtrend channel. So for now, the resistance is around $3 to 305 area, which was a previous resistance zone that we broke out of, and we came back to break down below it. As for the immediate support, around 278 to 290 area, which was a consolidation zone for SEM industries, which also meets with this channel support line over here as well. But if we do get lower than that, I think maybe the next level to look at around 268, 270 area, which was another important level, which was a resistance that we broke out of, and then we did a retest twice before the stock went up last time. And for venture, also not looking good. We broke down a swing low of around $16 today. So the next swing low we could visit is around 1557 March, created in March this year. Then around at the 50% FIBO retracement level, that's 1533 also. Another price level that we could revisit for venture if it continues to come down. So currently, I think the resistance zone which is quite strong is around 1630 level that we broke down off. Okay, for ILEC, using the FIBO retracement from the highs to the lows, recently, I think on Friday, we had a spike to the 38.2% level, 11, then we came back down pretty fast. Now it's like $6+. So I think we might be back in this previous resistance turn support zone. That's about 395 to 6, around 610 area over here. Last Friday, we also saw rejection at this trendline resistance for ILEC. Then for ISDN, we are currently in this downtrend channel over here. So the immediate resistance probably lie between 40 cents to 44 cents mark. And then for the immediate support, I think it's around 32 cents to 35 cents area. So last time, back in 2020, 32 cents was a support as a key to swing low level, which tested twice. And then follow after that, around 35 cents over here, which was another higher low that was created. So we could come back to test these levels if the stock continues to go down, and which also meets this downtrend channel support line over here as well. Okay, then Genting only in an uptrend channel, but let's see whether this support here around 77 cents can hold. The swing low here 76 cents, so 76. 77, let's see whether it can hold. If not, we might come back down to fill a gap over here. That's around 74 cents. Yeah. Then but even though we're in this uptrend channel, we have started to make a lower high over here. So previously we've been making higher highs over here, sorry. Then we have made a lower high around 81.5 cents. So we need to watch out for this counter, whether it will change from an uptrend to a downtrend. And for Parkway Life, we came to the support level of around 386 to 405 over here. So last time it was a consolidation zone back in 2021. If we go down further, it might go to maybe the FIBO level, 50% marks, around 373. Then if you are looking at the swing lows, bunch of swing low support created last time, that's about 357 to 367 zone back in 2020 over here. So that's for Parkway Life, the immediate supports. Some other key questions will be Sing Medical. I think for Sing Medical, currently it's sideways because of the privatization deal, so not much I can comment on, except that if last time we broke out of this 33 cents to 34.5 cents zone, then as for the resistance last time, it was about 39 cents to high of 41 cents over here. So currently we're about the midpoint, I guess, for the chart. What's my view on CICT and Mapletree Pan Asia Commercial? So okay, I'll share on CICT chart. So I think CICT also in this downtrend channel, but we kind of broke below it further. So that's a dangerous sign. Then we also tagged to a 50% retracement level at 181 already. So I think which is also meets with this swing low in May 2021. So if this level can't hold, right, the next one to look at is 176, which is another swing low in December 2020. Then other levels to watch will be is maybe 170 already, which is a 61.8% retracement level. For now, I think if you are looking to buy, average down or hold, I think we can still wait because probably the downtrend is still pretty strong for now. Yeah. And there's no signs of buying support currently to probably we need to see some sideways pattern to show that probably some base is starting to form, then more confident to buy to hold about. Geo energy currently potential cup and handle pattern, but we are still resisted by this handle over here. So very strong resistance seen over at 39 cents to 40.5 cents recently over here. Then if we go down to the bottom of this channel, we might go to 34.5 cents to 36.5 cents for some support for geo energy. Then for the uptrend, for it to have a potential to break out of this handle, right, we need to see this lower high form at 34.5 cents hold. Yeah. For Sheng Siong TA, I guess the uptrend is still intact. So currently the immediate support will probably be around 156 to 158 zone, which is the swing lows over here, and then also the channel support over here. For immediate resistance is this swing high of 163, and then also this another swing high of 167 over here, which might coincide with the channel resistance over here. As for Wilma, the selling pressure, it continues to remain strong. So I think we gone to the 61.8% retracement. That's 355. If we continue to sell down lower, I think the next window to look at is maybe 338 over here. So that's for Wilma. And sets. Sets, we have come to a support zone created last time. So I think immediate resistance wise will be this swing low that we broke out of to around 275, 276 level over here. And then for the next, there's a few support levels to look out for. So the first one is around the swing low last time around 265 over here. That's one. Then if you go lower than that, maybe it's around 260. So 260 and 265 are some levels to see whether the stock can go over here. Otherwise, the selling pressure still remains pretty strong over here. CLI, CapitaLand Invest, we broke down the 61.8% retracement level over here. That's about 330. So we have come to the next support level, which is the swing low over here around 318 to 325 zone over here. So let's see whether some support can come in for CLI over here. If not, I think the next support level might be at maybe 313, 305 to maybe 313, this zone over here. Is it a buy for 10 cent and Ping An now? For 10 cent, I think this has become a resistance. So the downtrend still remains strong. Then we also broke down further than the last swing low, key swing low over here around 251. So I think for now, still not sure whether the downtrend will end. So if we continue to go down further, the next level we might go down to is maybe 213 over here, which is another resistance last time. So for now, I think it's still too early to say whether it's a good time to buy. As for Ping An, I think it's a similar story. We just keep creating lower lows back down over here. Then I think the next level to watch out for is at maybe around the 36 level. So it was a previous resistance over here. If you go lower than that, then next level to watch out maybe is on 34. So for now, still early to say whether it has bottomed out. Yeah. For UMS, during the sell down recently, we put out of this bearish and shoulders pattern of this neckline over here. And then we also take to the 95 cents mark, the 50% retracement level. So let's see whether some support comes in. If not, the next level we might see is maybe I think the short term one is maybe this level and around 88 cents. Then the next one we might go down to is maybe 82 cents, 61.8% level, and so previous key level last time over here. Okay, maybe I'll just go through one more TA question, then we'll close for the day. For Jardine, looks like not looking good, might go down further. So this was around 31 60 this level over here was a previous resistance that we broke out of. Then technically it should become a support over here, but let's see whether some buying comes in over here. But currently still bearish candlesticks forming. So further downside could bring it to maybe 61.8% level. That's near the $30 level, which is also a psychological level to look out for this swing over here. So that's for Jardine. So I think that's all from me for TA today. I'll pass on my time to my colleagues for any closing.
I guess we can just wrap up. So thanks everyone for joining us today. Hope to see you again. Like not next week since it's Deepavali, but the week after. All right. Have a good rest of your week. Thank you. Bye bye.